Welcome back to our ultimate guide to maximizing stock profits. Today's explainer is all about cracking the code on market timing. Because let's be real, finding a great stock is just half the battle. If your timing is off, you are literally leaving money on the table. So we're going to make sure you know exactly when to make your move.
Right, so when is the perfect time to buy? It's the ultimate investing question, isn't it? We've all been there, sitting at our screens, sweating over the buy button, wondering if we're jumping in way too early or entirely too late. Because buying a phenomenal stock at the completely wrong time, yeah, that can leave you waiting years just to see a single dollar of profit.
So today, we're building up your analytical toolkit, going all the way from the micro to the macro. We'll kick things off with reading the price action, move into identifying market trends, check out momentum and reversals, and then wrap it all up with a massive macro-level look at the optimism strategy. Okay, Section 1, reading the price action. Let's get a bit granular here. To really read a single day of trading, we use the candlestick chart. Instead of just looking at a single basic price point or a random squiggly line, a candlestick actually tracks the open, close, high, and low price over a set time period. Honestly, every single candle tells a pretty fascinating story about the daily battle playing out in real time between buyers and sellers. The thick part of the candle is what we call the body. A green body, that means the buyers won the day. The price closed higher than it opened, and the bulls are firmly in charge. But a red body means the sellers overwhelmed them and the bears totally took the day. It is basically an instant visual scorecard of market psychology, letting you know exactly who had the upper hand by the closing bell. But you know, that thick body isn't everything. These thin lines extending out, the wicks, they show us the absolute full range of the battlefield. A long lower wick means sellers tried to tank the price intraday, but buyers furiously bought the dip and pushed it all the way back up before the close. If you spot that dynamic, a really long lower wick at the bottom of a downward trend, that creates a classic reversal signal we call a hammer. It's a huge clue that the selling pressure is finally exhausted. Now, what's really interesting here is how volume acts as the market's ultimate lie detector. It confirms if a breakout is actually backed by smart money. High volume means massive institutions are buying in. That is a genuine, powerful move. Low volume? Well, that's just small retail traders artificially pushing the price. It's super suspicious and highly likely to fail. You could literally have the most beautiful candlestick pattern in the world, but without heavy volume to back it up, you are essentially flying blind. All right, moving right along to Section 2, identifying market trends. Let's see how those single days build into broader movements. Because prices simply don't move randomly. They move in waves. An uptrend means you're looking at a staircase of higher highs and higher lows. In this kind of environment, pretty much every dip is a solid buying opportunity. A downtrend, on the other hand, consists of lower highs and lower lows. Trying to buy in a downtrend is exactly like trying to catch a falling knife with bare hands. Just don't do it. You always want that overarching trend to be your friend. To cut through all the daily noise and spot these major trends, we rely on moving averages. And the absolute holy grail here is the golden cross. That's when the short-term 50-day average crosses right above the long-term 200-day average. It signals that the short-term momentum has finally overpowered the long-term drag. Historically speaking, this is the most powerful buy signal you can get, practically shouting that a lasting bull market is officially underway. Conversely, a death cross is exactly what it sounds like. It happens when that short-term 50-day average crosses below the long-term 200-day average. Consider this your blaring red alert warning signal. It tells you the momentum has fundamentally broken down. It is time to reduce your positions and protect your capital before a massive sell-off really gets going. That brings us to Section 3, momentum and reversals. Now that we can spot those broader trends, we need to pinpoint exactly when the short-term momentum is shifting, just so we can nail that perfect entry. For that, we use the stochastic oscillator. Think of it kind of like a speedometer for stock momentum, measuring things strictly on a scale from 0 to 100. It shows us exactly when the buying or selling pressure has totally redlined and reached an absolute extreme. It doesn't give us the actual price, but it absolutely tells us the speed and the exhaustion level of the move. The crucial thing to remember here is waiting for confirmation. If the indicator drops below 20, we are deep in the oversold zone. Everyone is panicked, they've sold, and a stock is essentially coiled up like a spring. When it crosses back up and out of that zone, boom, that is your buy signal. On the flip side, anything above 80 is the overbought zone. Buyers are exhausted, the easy money has already been made, and when that momentum hooks downward, it's definitely time to lock in your profits. Finally, let's zoom all the way out. Section 4, the optimism strategy. This is our multi-year macro view.
So the percentage optimism strategy measures the current price against a historical compound annual growth rate, which is basically just the stock's normal, mathematically expected growth trajectory. It acts exactly like a giant pendulum, swinging all the way from maximum fear at 0% to maximum greed at 100%. And it perfectly dictates the 4 distinct seasons of the market.
The market cycles continuously through these 4 seasons. We've got winter, which is defined by pure fear. Then spring, our season of recovery, autumn, where we see slowing growth, and finally summer, completely driven by sheer unadulterated greed. This entire cycle is totally driven by mass investor psychology crashing into underlying fundamental value. We all feel these seasons in our portfolios, whether we actually realize it or not. When the optimism level drops below 25%, we are in winter. The news cycle is absolutely terrifying, analysts are out there predicting total doom, and your human instinct is just to run away. But historically, this is your absolute best shopping season. Buying high-quality assets during the peak fear of winter is honestly where true generational wealth is built. On the other hand, when optimism blasts above 75%, well, it's summer. The market is completely euphoric. Everyone on social media thinks they're a genius, and your neighbors are probably bragging about their massive gains. And you know what that means? The risk is remarkably high, the upside is severely limited, and you should actively be looking to sell to the latecomers. This brings your entire toolkit together into one clear action plan. You buy aggressively in the fear of winter. You hold steady through the cautious recovery of spring. You wait out the fading growth of autumn. And you decisively exit right alongside the smart money during the blind greed of summer. It literally takes all the emotion completely out of the equation. It all comes back to that legendary Warren Buffett quote, "Be fearful when others are greedy, be greedy when others are fearful." When everyone else is panicking, the smart money is out shopping. When everyone else is partying, the smart money is already quietly slipping out through the back door. So armed with candlestick charts, moving averages, momentum oscillators, and the optimism pendulum, you really have to ask yourself a hard question today. What season is your portfolio currently in? Are you just blindly swimming with the tide of public opinion, or are you actively charting your course with the smart money? Run the numbers, figure out exactly where you stand, and I will see you in the next explainer.